Good morning. Morning, Cav. Good morning, Joel. Good to see you. Good morning, Andy. And the rest of you folks lurking in the background. Good morning, Jeffrey. How we doing today, guys? You guys feeling it? Feeling good? Ready to go? Excited? Woke up this morning and said, you know what? I'm going to follow some rules today. I'm going to wait for advantages. I am going to pull the trigger when the rules are met, and I'm going to refuse to pull the trigger when they're not, because it turns out that's my highest chance of success. 81 yesterday, Ron. Very nice. Very nice. I went and played 9 holes the other day. Good morning, Wayne. It wasn't pretty. I was 10 over. 10 over through 9. And it was putting. So I got this new putter. And man, I didn't test drive it. So I had this weird idea that as long as I had a brand new putter, the ball was going to fly off the face and go in the hole. I know I could have used a pool stick. And I left everything short. Everything short. I 3-putted. I think I 3-putted 7 of the 9 holes. So it was like bogey, 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 bogey. It was greens in regulation. My swing was on. And I couldn't putt to save my life. It was sad. But you know what? I was excited about the swing. Yeah, Calf, I don't even drive for show. I hybrid for safety. We need to, Ron. One day. I'm a total chicken, Wayne. I suck with the driver. I can hit, true story, guys, I can hit a 6-iron almost as far as I hit my driver. There's just something about the iron swing. It makes sense to me. I can crush it. And there's something about the driver swing. I get in my head and I'm not smooth. And that's it. I know. One day I'll get it. No, my 6-iron's pretty kick-ass. I had a 200-yard 6-iron straight up the fairway yesterday. So, or the other day. That's fine for me. I'll take that all day long. Because if every par 4 is under 400 yards, I can get there in 2. But yeah, there's a lot of work that my golf game needs, but I sure do have fun with it. The Gators down here, you always carry a 12-gauge driver. You golf with a 1-iron? Man, you and what's his name, Nicholas? Yeah, Wayne, you're absolutely right. I do need to practice the driver. What I really need is just to take a day at the range with nothing but the driver, and see what happens. Does this have when Trump speaks? Did Trump speak, Nanda? Did we miss the Trump speaking? It can, so the calendar says, today's Friday, February 28th. I don't see anything about Trump speaking today. There was yesterday at 3:30. And man, anytime the commander-in-chief speaks, he could say something that can make the world go sideways, right? He can say something that makes investors panic, that makes them confident. So Trump speaking will always be a potential, hey, let's wait and see what he says kind of thing. This morning we had the PCI price index. I don't disagree, Nanda. So guys, what we're looking at here, and we're starting to talk about news, we're going to get away from golf, even though I really do. I absolutely love that we can hang out and chat about stuff in this room. But, you know, John Novak's gonna knock on my door and make my phone ring and say, hey, go teach some people. So we're going to do that. We're going to go to forexfactory.com/calendar. And I do this every morning, guys. This is literally, I open my charts and I'm sipping on my coffee. And before I even look at an indicator, I go and check news because I want to make sure that there's not a high impact news or a medium impact news, because both can make the market jump, spike, bounce. It can make it too fast to trade. It can change the market's direction without warning. So anytime I see a red box or an orange box, couldn't care less that it's Chicago PMI. Means nothing to me. What means something to me is that there could be a reaction from somebody with more money than me, and I don't want to get into their emotional roller coaster. So if you were watching at 8:30, I'm pretty sure at 8:30, let's take a look. This is the NASDAQ. So at 8:30, wow, hold on, I'm trying to get to 8:30 proper. There you go. That was 3 minutes worth of market. 3 minutes. That huge spike up was based on the news. So when you check it, honestly, this is kind of the first advantage you can give yourself, is you can say to yourself, man, there's going to be an emotional reaction, at least potentially. Let me choose to do nothing. Let me go scramble an egg. Let me go toast a waffle. Let me refill my coffee. Let me remind my spouse how much I enjoy this classroom in the morning, whatever you have to do, other than jumping in front of that freight train. And then everything that we talk about, guys, every day, it's the same thing. It all comes from the Nexgen page. There's the education tab, and there is the software guide, scramble an egg. Yeah, they've gone up a little bit, haven't they, Ron? There's the software guide, and guys, this is your NinjaTrader how-to. This is opening, closing, building charts, changing trigger sizes, scaling charts, building new charts, trading view. Ooh, John added trading view in here. Guys, if you're a trading view user, I want you to do me a favor and let me know. I spoke to my brother this morning, and hopefully next week we're going to recruit some of you guys to try to break the funding company. Kind of a last test before we go live. So if you are a trading view person, go through these basics. Make sure you can navigate a little bit. But all of that is kind of NinjaTrader how-to. If you have a question about anything on NinjaTrader during classroom hours, just ask. I'll do everything I can to help you. But I'm not going to lie. I'm not the techiest tech in the world. And very often I will direct you to Jason, who is the techiest tech in the world. But we're going to talk about stuff from the trading guide. And from the trading guide, I'm going to scroll this one real quick. Everything that I talk about is in the trading plan. So we're going to talk about one trade. Everything that I discuss in the first hour, you can find right here. So if you want to go back after hours, put your eyes on some rules, work on some management, all that good stuff, there it is. And then when you scroll down, there's a lot of information. There's a metric ton of information in this website, on our YouTube page, in the Discord channel. But what I do in this room is every morning I talk about one trade for the first hour. I talk about a high probability trade, and I do this because the high probability trend trade, the trade that we discuss, this is your foundation. And this is a trade that typically wins 70 to 80% of the time if you follow the rules. This is a trade that creates an awful lot of confidence for new users because of that win percentage. But most importantly, some of you guys are mouthing the words like this is your favorite movie because you know what I'm going to say. This is the trade that teaches you to read your charts, guys. That's the goal. And it seems like a weird goal, right? I signed up to be a day trader. Guys, I want you to be a chart reader. Because once you're a chart reader, you'll realize that you're not a day trader. You are a professional waiter, and your job is going to be to wait for advantages. 90% of your day, each and every day, you're going to find that it's just waiting. It's sitting on your hands. It's doing nothing. 10% of your day will be actively trading because the market is presenting you with a pattern that has been proven to win more than it loses. And those are rules. Rules describe that pattern. But once you can read your charts, you will understand where the market is most likely to continue. This is your entry for the highest probability trend trade. This is pinpointing where the trend is most likely to just keep going with the overall trend. You're going to understand where the market is likely to go. This is going to help you make good decisions on profit targets. And then I think most importantly, you're going to understand where the market is likely to stop. These are what we call termination conditions, guys. And one of the biggest advantages that Nexgen provides you guys is you can see on your chart, like right where the market could reverse, could bounce, could fight. And you can choose not to trade into those areas because they're amazingly important, and they're easy to recognize. So we're going to use 3 rules. These are the 3 rules for the high probability trend trade. And you're going to hear me say a lot throughout the day that this is nothing more than a pattern that repeats itself. This is nothing more than a pattern that has been proven to win more than it loses. And this is nothing more than 3 working parts, 3 moving parts, 3 advantages in yellow. And that's the recipe for a trade. Trading shouldn't be about your emotions, and trading shouldn't be about your opinions. And if you ever say it should, then you're probably breaking away from your rules. So each rule, 1, 2, 3, is designed to give an advantage. 1, 2, 3. So it takes 3 advantages to enter the highest probability trend trade. There's momentum, and then there's a clear path. And then entry is where the market is most likely to continue. And what we're going to focus on this morning is breaking down each of these rules individually. So we're not going to say, hey, here's the trade. I'm literally going to break it down. Hey, here's momentum, and if I have momentum, then I'm going to look for a clear path, and I'm going to couple it with momentum. And if I have both of these, then I'll look for an entry area. And what it does is it kind of helps you with a little adherence to sticking to those rules, to having those advantages. Momentum and path are your core. These are the 2 that set the tone for everything you're going to do with this software. And once you understand these 2, that's when the doors open. That's when you begin to see more trades. So I'm going to encourage you, make sure that you're comfortable with momentum, and then move to those termination conditions, recognizing a clear path. Once you have these 2 down, I'm going to give you the entry rules for the highest probability trend trade, but what you're going to find is that you're probably going to create your own entries. You're going to begin to recognize patterns that are bringing you success, that win more than they loses, and you're going to develop your own trading plan. These 3 rules that we talk about each and every day happen on only 2 charts. And again, there's a lot more options. We're giving you guys the absolute best of the best this morning, the highest probability of success for the new user. The large chart, the chart on the left, the 13-2, this is a very broad stroke of a brush. It's a slow moving chart. And honestly, it's difficult to see change on this chart, which is why it only takes 1 bar. 1 bar, the most current bar, is all you need on this large chart to define direction, momentum, and areas. Your first 2 rules, the rule 1, giving you the advantage of momentum, rule 2, giving you a clear path, these must be met on the large chart. And when they're true, what you have is a market that has defined the trend, that has given you momentum in the direction of that trend, and there's absolutely nothing in the way. And guys, these are amazing advantages to have, so much so that when these are true, you'll go to a smaller, faster chart, a refinement chart. And this smaller chart is going to show you the inner workings of that 1 bar. This smaller chart is going to show you probably 20 to 30 bars worth of movement. It could be a retracement and a bounce, but it's still going to be inside of this large chart that doesn't seem to be showing any change at all. This is how you guys are going to be able to refine, to pinpoint the best of the best entry. Hey, good morning, Morgan. Hey, don't let me forget, Morgan. I do want to talk about the picture you posted in the middle of the night last night, because I think there's some good lessons in it. I hope you saw my response. Guys, when you enter on this smaller, faster chart, you will be able to reduce risk dramatically. You're going to be able to increase your profit potential. And rule number 3 is specific to a trend trade entry. And it's only used when the large chart says that it's time to look for that entry. So we use these 2 charts. They really are. They're just telling you who you're trading with or who you're trading against. The large chart, the slow chart, it's the large crowd. It's the men and women with the deep pockets and the influence to create trends, to establish momentum. These are the men and women that react at those key areas that you're going to be able to see. And trading with the large crowd tends to be the highest chance of success. The large crowd wins more than they lose. Your small chart, I want you to think of them as the small crowd. And the small crowd fights. If the large crowd says up, the small crowd wants it to go down. And if the large crowd says down, well, the small crowd wants it to go up. But when the large crowd is going up with momentum, with nothing in the way, the small crowd is likely to fail 70 to 80% of the time in their efforts to counter that large trend. And you're going to use rule number 3 to pinpoint right where their failure is most likely to happen. If they're losing to the large crowd 70 to 80% of the time, it puts you in a position to win this trade up to 70 to 80% of the time. So we're going to remember to always trade with the people that are in control. And here's how the next hour is going to go, guys. We're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. And I love that phrase, okay to trade. It's okay to trade when my rules are met, because my rules are just describing a pattern that has been proven to win more than it loses. That gives me an awful lot of confidence. It makes me feel good about it, and it assures me that if I continually follow my plan, if I'm consistent with my rules, then I'm putting myself in a position to win more than I lose, and that's a great recipe for success. You guys have the ability to simulate, whether you are an owner, a leaser, or you're just in your demo. You've got a working copy of the software. You've got a platform to run it on. You have the ability to enter and exit trades. Everybody in this room was given capture software when they downloaded. So not only can you take trades, you can take pictures of everything that you do using that capture software. And that's the first step to becoming a confident trader here in the Nexgen room, is post your trades in the class. Every trade, win, lose, or draw, you need to know what you're doing right and wrong. You need to know what you need to continue to do and what you need to avoid. That's where I come in. Every time you post in my room, you show me what you did. We're going to talk about those advantages, and you're going to get a private session with me, essentially. We are going to look at all the good things, high five, celebrate, and we're going to look at the things that might be a little counterproductive, and we're going to come up with a plan together to avoid those things so that you can focus on the successful patterns. The goal is that you always have the correct rules, because the rules have been proven to win more than they lose. A lot of people are like, well, it's just simulator. I'm going to break some rules. I'm going to challenge the market. I'm going to take some risks. And what happens is the market is going to let you win those trades. The market loves it when you get lucky on simulator, because then you bring your real capital to the playing field, and all you've done is practice bad habits. And typically luck runs out the second you go live. Don't ask me how I know. So focus on rule adherence, but be okay breaking them in the beginning, because you're just learning them. We're going to simplify today. We're going to focus heavily on that high probability trend trade. It's going to teach you to read your indicators, and then your ability to read your indicators is going to open the door for what we call a medium probability trade, which is almost a high probability trade, but there's a problem. The trade that I give you will have to do with that clear path, and you're just going to have to use your chart reading to be able to manage it a little more assertively, to be a little more cautious on your entries. But that's going to come from your chart reading. And I'm going to hand you this plan. You've got to learn the looks. You've got to learn the trigger line of Fibonacci looks so that they get easy, which means that you need to be able to recognize the advantages. You need to be able to piece them together to recognize the complete pattern. That's the second step in getting to where you want to be ASAP, guys. Use the spreadsheet. Oh, please use a spreadsheet. Wayne, you said the other day you were hard-headed. I don't think I reacted to that. You just started keeping a spreadsheet. Guys, I'm telling you right now, repetition creates recognition. I can't say that enough. Repetition creates recognition. As smart as I believe I am, I don't remember everything. But if I have it here, I can go study it. So there's 4 tabs. There's 4 tabs. On the first tab, these are your rules. These are the 2 foundational, the core rules, strong triggers and clear path. And you need to know exactly what they look like so you can have those advantages, because that's what tells you it's time to look for the entry. But you also need to know what it looks like when they're not met. because that's when you're going to embrace that 90% and do nothing. So I'm going to give you something to help you fill this out. But man, I've done an awful lot of work for you. The goal is that you get in and you start doing a little work on your own. Create that recognition through repetition. The second page, this is the client trades. Over 400 pictures of you guys doing pretty cool stuff with the software. And I'm going to tell you right now that not every one of these pictures is a winning trade. It seems like from a marketing standpoint, I should only show winning trades. Guys, I want to be honest with you. Anything that wins 70 to 80% of the time loses 20 to 30% of the time. It doesn't mean that losers are a negative. Learn how to take the right losers, good losers. Take the losers that have the advantages and avoid the trades that don't. Those are what we call avoidable losses. And those are losses that just eat into your P&L. So you're going to see stuff that says perfect long. Look at that. Perfect short didn't work. I'm not afraid to show that to new users because that was the perfect pattern. We saw it yesterday as well. Defining where the market is most likely to continue, the entry sequence, that small chart sequence to get you into the best of the best trade. There's one for long and short. There's a very mechanical management plan, and then ideas on when you can manage differently, not as a new user. There's some stuff on the NASDAQ here. The NASDAQ moves about 10 times faster than crude oil or the S&P. I teach on crude oil and S&P. Sometimes we go to the NASDAQ and look at it. Guys, I will talk about any market that you want to talk about. But I keep it mainly to crude oil and S&P. You're going to begin to recognize patterns. You're going to use them for entries, for management, for the next trades. And these patterns start to jump off the page at you once you begin to recognize these advantages in these trades. You begin to see more. So there's the build your plan section. This is where your pictures are going to go. You're going to make your section look like my section. You're going to put all these pictures in the same way I did. The pattern that's going to get you in goes in the green section. The way you're going to manage outside of the very basic management plan goes in the orange section. The patterns that repeat themselves go here. And I'm going to encourage you guys, every time you take a picture, get it in there. And Wayne has the same thing. Got your trade journal, right? Going through it, rocking it out. Pretty cool. And you've got them all over the place. Is this daily? 820, 280, 2800, 940. So these are all your trades for the day. I love it. Guys, if you go back and study your trade journal, thanks for sharing that, Wayne. If you go back and study your trade journal, check it out. That's the last tab. What happens is there's a couple things that you can do, but I'm going to show you how I want you to use it, how the most effective way to use it is. Every day you fill it out with your trades, right? And then the next morning you wake up and you take 5 minutes out of your busy day to look at the trades that you took yesterday. And you're going to say to yourself, this worked. Man, every time I had momentum and a clear path and defined that entry area, it feels like I couldn't lose a trade. And then you're going to say to yourself, this didn't work. I traded into a termination condition. I traded without the advantage of momentum. I got in from the wrong side of the triggers, and you're gonna see these patterns, and you're gonna study them, and it's gonna set you up for the day. You're gonna begin to recognize the patterns that are bringing you success. You'll see that from the feedback section, and you're gonna recognize the patterns that seem to be taking that success. And what happens is when when these things begin to repeat themselves, that's your thing. Everybody has a thing. My thing was trading into termination conditions. Not gonna lie. Some days it's still my thing. There was a point in my education where jumping in too early was my thing, and I had to go through. And I actually posted pictures in my brother's class, and he gave me feedback, and he said, "Hey, Mark, this is what you're doing. Here's how you fix it." And that's exactly what I'll do for you guys. So as we get going, understand that the first hour is a little lecture-y. I understand that. We're going to go through these very core, basic ideas. The second half of class is 100% feedback. So if you're newer in here, you see a lot of people posting pictures in this room, posting those screencast app account link things. Sorry, I lost my train of thought. After we discuss, after we discuss rules, after I give you everything that you need to be successful with the software, and I promise you I'm going to do it, that's when we go back and we start talking about these pictures that have been posted in the room. Because every picture in the room, I'm going to go back to momentum, path, and entry, and I want you guys to understand those concepts so that you can get the most out of the feedback. So we're going to get going, and we're going to start with just a, hey, this is what you see on your charts. This is your roadmap, if you will, your legend. Every chart has triggers, small triggers, large triggers. Small triggers are solid. 2 solid lines make up the small triggers. 2 dashed lines make up the large triggers. Smaller, fast. Larger, slow. That's it. That's all you need to know. You're going to use trigger lines on both charts. You're going to use them to define momentum with rule number 1. You're going to use them to define termination conditions with rule number 2. And you're going to use them to define entries with rule number 3. So know the difference between small and large. You also have areas. Areas are going to be on both charts. And again, depending on the chart, they'll have a different role. But let's learn the names. You have divergence, highs, and lows. Anytime you hear divergence, I want you to say to yourself, loss of momentum. So divergence highs print, the magenta line, when there's a loss of momentum at a high. Divergence lows print when there's a loss of divergence at the low. And Wayne annotated a chart for us that we're going to go back to and see. And he had the perfect description of divergence at a low. I'm excited about sharing that with the class. You're going to see Fibonacci resistance. These are those red lines, horizontal, run across. They can stop the market when it's going up. Blue Fibonacci support. They can stop the market when it's going down. You're going to see yellow 1-to-1s. Depending on the direction of the market, they can be support or resistance. And then you're going to see a mid-band. And this mid-band just runs through the middle of things. It's a big moving average. When price is above it, it'll be green. It can behave as support. When price is below it, it can be magenta and may behave as resistance. So know that these areas are on both charts. On the large charts, they're going to define trouble. On the small charts, you're going to use them to define entries. Just know the names, and you're going to get this PowerPoint. But let's get into rules. Love rules. My rules kept me out of about 7 losers this morning. Just saying that. I didn't take a lot of trades, but I avoided a lot of losers by following my rules. And man, that's a good feeling. And when that happens, you really start to develop some trust in your plan. So everything starts on the large chart, and the large chart needs strong trigger lines. Remember, the large chart leads the way. The big chart, the slow chart, the large crowd. First bar on the large chart. And guys, that's going to define direction first. If the background is green, it's going up. And if the market's going up, I want to go up with it. So if the background is red, it's going down. And if the market's going down, I want to go down with it. I'm going to go with the flow. I'm going to run with the large crowd. And this is important because the only way I can have strong triggers in an uptrend is if everything's green. My background is green, my large triggers are green, and my small triggers are green. And in a downtrend, everything has to be red. If the colors don't match, if the small and the large are different from one another, if the triggers are different than the background, you don't have strong triggers. That's part of your 90%. You're going to sit on your hands and wait. But if the colors match, if the small triggers are up and above the large triggers, if the large triggers are widening, angled in the direction of the trend, or in a downtrend, the smalls are below the large triggers, space between the two. Guys, this space lets me know that the odds are favorable for the market to continue in the direction of the trend. Hey, good morning. Odds favorable momentum is what we talk about every day, guys. Odds favorable momentum. That's your first rule being met. That's strength. And strength, momentum, has the ability to push the market in the direction of the trend. It's very difficult to stop. Momentum is what it takes to break those key Fibonacci areas that could be problematic. And guys, momentum can even cover a lot of the mistakes that new users tend to make. So strong triggers leads the way. It's not hard to recognize, and we'll go to the large chart real quick. And there we go. Smalls are above the large. The large are starting to widen. Guys, this is odds favorable momentum on the first bar. You can identify it. It doesn't mean there's a trade. It means you have the first advantage met as you look for a trade. Here we go again. Everything is green, smalls above, space between. Once again, it doesn't mean go long, but it means you do have the advantage of momentum. You have 1/3 of what you're looking for to take those trades, to look for that entry. And then finally, I love futures. Smalls below the large, larger wide, everything's going down. I have odds favorable momentum to the downside. But again, that's not a complete trade. That's only rule number 1. So can you guys give me a why in the room? If you're good with momentum, let it lead the way. It's hard to stop it. It is a loaded freight train that you don't want to step in front of. And guys, when you have strong triggers up from the point of separation till they close, this is where we're looking for those entries on the smaller, faster chart. On your large chart, because it's such a slow chart, sometimes you'll see these tails or these wicks. Rule number 3 is designed to pinpoint where those tails or wicks are most likely to happen. Those are actually pullbacks, that small crowd fight on a smaller, faster chart. So you're going to use this to study. You can go back historically, and when you see the rules met on the large chart in one of those tails, circle it. If you go to the small chart and it's a pullback to areas inside, what you're doing is you're creating that pattern recognition. You'll put the two together. We'll look at a couple of these when we get through entries and towards the end of this little session here. So rule number 1 is met. I have the advantage of momentum. Now I can look for rule number 2. Rule number 2 says termination conditions false. Room to profit targets true. Clear path. That's all we're going to call it, guys. Clear path. A clear path means there's nothing in your way to create a bounce. There's nothing on the large chart in the way that may stop the market, create an untradeable bounce, nothing that could reverse it completely. No termination conditions, and that's exactly what a termination condition is, guys. It's a horizontal line on a large chart. It is Fibonacci support, Fibonacci resistance, yellow 1-to-1s, a cyan divergence low line, or a magenta divergence high line. Those are the horizontal lines on a large chart that may stop the market. And you're going to know whether or not they're likely to stop it with a comparison of the area and the trigger lines. You're also going to see 3 divergences in the same area. This happens on every time frame. You'll see it on a small chart first. This will be the only termination condition that you'll acknowledge, recognize, and respect on a small chart. And then on the large chart, the mid-band can behave as a termination condition, but only if the large triggers are a full bar away. So we're going to go through and we're going to cover all of these, but we're going to lump support, resistance, 1-to-1s, and divergences into the exact same group. These are the areas where the large crowd are most likely to respond, where they're most likely to fight, where reversals can happen, where fights can occur. So the first step in identifying a termination condition is you're going to let price get to resistance. You're going to let price get to support, those dynamic Renko bars. And I'm going to tell you something. If price is right here, that's not a termination condition. That's a target, ladies and gentlemen. So price reaches the area is the first step. Once price reaches an area, we're done with price. We don't need it anymore. It doesn't matter what price does. We're going to go to the trigger lines, and the trigger lines will tell the story. So you're going to ask yourself, where are my triggers? Price reaches, where are my triggers? If they remain below resistance, if they remain above support, those areas are a termination condition. And a termination condition can create a big, ugly, untradeable bounce. And a termination condition can set off a fight between the large crowd buyers and sellers that you don't want to be a part of. A termination condition may break. They break all the time. Or that termination condition may actually reverse the market. It might make those large triggers go from green to red or from red to green. And guys, if price reaches an area and the triggers can't break, creates a reversal, we're going to call that a strong top or bottom. And a strong top or bottom is the precursor to the highest probability trend trade you can take. A strong top or bottom is rule number one for almost every trade that Nexgen teaches beyond the high probability trend trade. So learn to recognize it, but understand areas may break. And when an area breaks, it looks like this. Notice that the market has odds favorable momentum, strong triggers. That's what breaks areas. But when price reaches resistance and those trigger lines remain below, this is a termination condition. And I want you to be real honest with yourself. You'll never know what the reaction will be. You'll use words like it should break, it's going to break, it has to break. But the reality is it doesn't. It doesn't have to do anything. So if price reaches an area and the triggers remain below resistance, guys, sit on your hands. Wait for the reaction. You don't have to be in the market every second. And here's the cool thing. If those small triggers smash through the area, but the large triggers lag behind, as long as there's odds favorable momentum, this area has the potential to break. You can take trades with potential. But rule number 2 isn't met yet, which means that it's only potential. It's not a clear path, which means you're going to have to manage assertively. Because if something changes, you're going to want to exit instead of hope. And then once both lines of the small and large get above resistance, resistance is now broken. Your path is now clear, and your path remains clear until the next area is reached, until you hit the next horizontal line. And once you hit the next horizontal line, you go right back to step 1. You'll notice that once an area is broken, resistance behaves as support. And once an area is broken, support behaves as resistance. And it looks the same going both ways. And let's go to a large chart again because I love my large charts, but it seems that I crashed my Ninja Trader from doing too much stuff. So let me pull that back up and get it loaded, and then we'll go to a large chart. While we're doing that, let's talk about those 3 divergences, guys. 3 divergences in the same price range may terminate the trend. 3 divergences could create an untradeable bounce. 3 divergences could set off a fight. And really what 3 divergences is that's hard to say, is the small chart showing you change that you can't see on the large chart. Remember, 1 bar on the large chart can show you momentum. 1 bar on the large chart can show you a termination condition, the potential to break, or a broken area. Inside of that 1 bar is all of this. There's a yellow box around the bar. All of this is happening inside of there. And if you ever see 3 divergences, 1, 2, 3 in the same range, guys, that may terminate the trend. That's the small chart showing you loss of momentum, loss of momentum, loss of momentum. And it takes 3 to override that odds favorable on a large chart. This is actually the only time I'll let the small chart talk me out of a high probability trend trade. And then finally, the large chart midband, if the large triggers are a full bar away. This is what we call the gap theory. One of the things that you'll recognize about your large chart and your small chart is that when price pulls away from large triggers, it tends to always return. And when price accelerates away from those large triggers and smacks into a fib or a midband, in this case the midband, if those large triggers are a full bar away, it's like a vacuum and it sucks price right back up to close those gaps. And any trade you take in between that midband and those large triggers is more likely to get run over than it is to be successful. So this is how we're going to define the midband as a termination condition. We call it the gap theory because the market closes the gap with that sort of distance. This idea that price returns to large triggers is going to pay dividends when we're looking for entries as well. So, sad news, new users. There's going to be times, there will be times, absolutely positively will be times when your path isn't clear because the areas are stacked a bit. And you're going to say, well, Mark, where's my entry if I don't have a clear path? And I'm going to say, well, you don't have one because your rules aren't met. But it's okay. This is 90% of your day. And it's okay to do nothing. And the futures markets trade billions every day, sometimes trillions. And it's not necessary to be in every move. Guys, be in the best moves. Be in the highest probability moves. If you can capture $400 in between these fibs with all that momentum and nothing in the way, $400 a day is a six-figure income based on your trading. Guys, it's not necessary to be in every move. So we just brought crude oil back up. Let's take a look. Weak triggers, and there's a reversal. Potential to break but didn't. Look at the bounce. Potential to break but didn't. Look at the bounce. Mid-band large triggers are a full bar away. Look at the bounce. Oh, it's almost like we can predict it. Potential to break did not. Mid-band pulls back to the triggers. Pushes back, retests. Potential does not. There's your termination condition. Price reaches, triggers don't break. And ladies and gentlemen, that termination condition sets off the move to the downside. And there's your trade. Right after the termination condition. We're going to circle that one. Look how long that trade runs before the first bounce. First bounce comes from weak triggers, goes all the way to resistance in the form of those yellow 1-to-1s. Triggers remain below. Resistance holds, market trends down. Loss of momentum. Tries to retrace up, can't do it. There's your termination condition, right at a divergence low, price reaches, goes to resistance, back to support. Do you guys see how rule number 2 is keeping you patient, keeping you out of consolidation, keeping you out of chop? Guys, that is a beautiful example of when you should be waiting 90%. I don't have momentum. I don't have a clear path. It's less expensive for me to do absolutely nothing. And guys, rule number 2 became a rule because Nexgen over the last 30 years has done an awful lot of study. And more often than not, when the rules for rule number 2 are true, when those termination conditions are true, the market stops. You lose money if you trade into that area. So this is a great safeguard. It's also the most broken rule because it means that you have to be patient. It means you have to sit on your hands. So is everybody good with termination conditions? Or at least a little foundation there. Don't trade into lines. That's the easiest way to say it. Hey, what if I forget the trigger thing? Don't trade into lines. Let them break. Trade from lines instead of into lines. You'll be amazed at how much success you find. But once I have momentum, once the path is clear, guys, this is where the precision comes in. This is where the high probability trend trade entry happens. And it's pretty exact. You're going to use a limit order to buy or sell that pullback that the small crowd creates with their fight. And you're going to do it in an area inside of triggers, guys. This is rule number 3. This is the small chart. We're done with the large chart. The large chart's given us momentum. The large chart has established that we have a clear path. We're just going to go define entries, guys. And we're going to use that limit order to buy or sell a pullback at an area inside of triggers. And those areas are inside of triggers for the same reason. The mid-band can be a termination condition on the large chart. Price tends to return to the large triggers, whether it's the 5-1 or the 13-2, the big or the little. So your trigger lines will define where the retracement is most likely to go. The trigger lines define where this push down is most likely to keep going down from the lowest line of the triggers to the highest line of the triggers. It defines where the retracement is most likely to occur. So, brand new users, I promised you the best of the best. If your large triggers from both charts, and they're both on your entry chart, if they are overlapping, one on top of the other, 2 snakes riding piggyback, we call this favorable large triggers. Favorable large triggers give you the smallest range where the retracement is most likely to go. When you start putting areas, fibs, mid-bands, and yellow 1-to-1s inside of those favorable large triggers, this is the best of the best. This is the least amount of risk. This is the easiest, the highest accuracy entry. Guys, this isn't the only entry. This is the best entry. Sometimes it's going to look like this, and the wider they are apart, the more indecision there is. So favorable large triggers, new users. Let's define an entry. Have I mentioned that the rules on the large chart need to be met? That you must have odds favorable momentum, that you must have a clear path if you're trying to take this trade. If you don't, it's not a high probability trend trade. But if you do, your small chart's going to look like this. It's going to be railing to the upside with that large chart trend momentum and clear path. You might eyeball, hey, there's an area, here's my triggers. But guys, it's not time to enter yet. You've got to kind of hold your horses, wait for a reversal bar. Now the reversal bar is exciting. And you're like, oh, here it comes, here it comes, here it comes. The reversal bar is not your entry. The reversal bar signals the beginning of the fight, the beginning of the retracement, that pullback. And price tends to return to large triggers. So when I see that reversal bar, I'm going to define where the retracement is most likely to occur. Somewhere from the top of these triggers to the bottom of these triggers. And the tighter they are, one on top of the other, the higher the accuracy. But triggers don't create bounces. Triggers are not entry points. Entries are going to come from areas. Areas inside of triggers. Guys, I want you to capitalize that. Every time you write it on a chart, my entry comes from an area inside of triggers. Areas can be fibs, midbands, or yellow 1-to-1s. Areas are not divergence highs and lows. Areas are not pink 1-to-1s. Fibs, midbands, yellow 1-to-1s. So this box, from the highest area inside of triggers to the lowest area inside of triggers, guys, this shows me where the market is most likely to bounce in the direction of the trend. Price is a tennis ball. These areas are my brick wall. This is where the small crowd is most likely to fail. This is where continuation with the trend is most likely to happen. You give this 4 or 5 days of solid study, you'll have the courage to activate a limit order. Wait for the market to come to you about 2 ticks above that highest point of support. Because remember, your large chart has odds favorable momentum. Your large chart has nothing in the way to create a bounce. You're going to get in at that highest point of support. Not going to trip over a couple pennies hoping it goes to the midband and ignores the fib. And guys, if the market pushes back, if that retracement goes to the area where the market is most likely to continue, if it hits your limit order, you're in a long position. And you're not just long because you hope it goes up or because the news said it should. You have the advantage of a market where the odds are favorable for it to continue up because you have strong triggers on a large chart. You have the advantage of a clear path. You have room to your profit targets because no termination conditions are present on the large chart. And you have the advantage of having entered precisely where the market was most likely to continue up with the trend, precisely where the small crowd is most likely to fail. And guys, this is your high probability trend trade entry. We haven't talked about making money, taking money. We haven't talked about anything other than pinpointing where the market is most likely to continue using 3 simple advantages. So we're going to go through it again, both directions. The reversal bar begins the pullback. Rules are met on the large chart. Reversal bar is not my entry. Guys, if you just couldn't hold your water and jumped in, the reversal bar says, get the hell out. We're probably going to create a trend trade when the large chart rules are met. And a lot of you are going to jump in. That's your exit condition. When the reversal bar prints, and honestly, you're going to start looking for this over here once you get a little experience, but when the reversal bar prints, define where the retracement's most likely to happen, guys, from the high point of the triggers to the low point of the triggers. But the trigger lines are not your entry. You need areas inside, all caps, different color, whatever it takes. JR, I don't know what 2 question marks mean. Until I put a ring on your finger, I need complete sentences. I can't read your mind. What's confusing you? Well, go ahead. Type it in. It takes less time to type the question. Just type it. You guys can always interrupt. Just type your question in. I'll stop. I'll see it. I'll go to it. I promise. Reversal bar, define the retracement zone. Define the areas most likely to create the bounce inside of triggers. And guys, this creates your window of opportunity. JR, you can do whatever you want. You can do whatever you want. But the 50-50 rules are different than the high probability trend trade rules. So I encourage people to make sure they understand the high probability trend trade rules before they try to chase the other trades. You can go counter trend, you can fight momentum, you can trade directly into areas. I'm not the boss of you. But the likelihood of success goes down dramatically. So what we're doing right now is I'm trying to get you locked into the best of the best. And you'll have time to grow. You'll have time to grow outside of this. But creating this window, defining where the market is most likely to continue, guys, this does so much. It helps with management. It helps with decreasing risk. It helps with creating more profit potential. So we learn this first because you're going to realize that anything on the wrong side of those triggers is outside of that window of opportunity. Anything below the triggers in a long trade, this is where the market shouldn't go. And that language is going to pay dividends as you learn to manage. In a short trade, no worries. Ron, enjoy your weekend, man. Enjoy your weekend. Go live life. When the large chart says down, when the large chart has momentum, when the large chart has a clear path, I'm going to wait for an up bar on the small chart. It's not my entry. At the time of the up bar, the reversal bar, I'm going to look for my triggers and I'm going to say to myself, the market may retrace somewhere from the bottom of these triggers to the top of these triggers. That's my retracement zone. And I'm going to remind myself that triggers aren't bouncy. I need an area inside. Fibs, mid bands are yellow 1-to-1s. This one line inside of triggers, all caps again, this is where the market is most likely to bounce and continue in the direction of the trend. Guys, this is where the small crowd is most likely to fail. You're going to put your limit order 2 ticks below it and hope for the best. And I want you to see this. The market tried to push up here and didn't. And if you broke your rules and jumped in on the way down, you probably got run over as they came back to the perfect entry. And you were too busy being angry about it that you didn't catch the right entry. So guys, really focus on your rules in the beginning. Because defining where the market is most likely to continue defines where the market should not go. Anything on the wrong side of the trigger lines, you have no idea if or when that market's going to stop, if it's going to bounce, if it's going to head down. This is the wrong side of the triggers. Any lines over here are not a part of the equation. And where the market should not go is where your initial stop's going to be. And that's why it's so important. Nail these entries, guys. Give yourself 5 days to figure out these entries. Ask a million questions to make sure you can do it. And here's the one thing I'm not seeing from my question askers. Post some pictures in the room. Show me what you see. Talk about what you see. This is where my stop goes, because where the market shouldn't go is where my advantage is no longer present. Where rule number 3 is no longer giving me the highest chance of success, it's out of play. And guys, I'm very willing to lose a trade when my rules are met, but I'm not going to lose it huge. 4 to 5 ticks, that's all I'm willing to give up, where the market shouldn't go. So you got to learn the pattern. This is what it looks like together. And JR, that's one of those 50-50 looks. See how the bottom line of the large triggers hasn't made it through the fib yet? It doesn't change the rules for the entry. When you have momentum and a clear path, or at least the potential to break, you're looking for a pullback to support inside of favorable large triggers. Guys, this is your pattern. This is the pattern that wins more than it loses. This is the pattern that reduces risk. This is the pattern that gives you the most room to hit your profit targets. So you got to go learn it. You got to look at it. Let's see if we have one. Look at that. Rule number 2, still keeping you out of shenanigans. Does everybody see the termination that reverses the market, that creates odds favorable momentum, and gives this area the potential to break, guys? That's the key. Whoops. That's the best look on one of those 50-50 trades. Let's go look at the circle. Let's see what it looks like. Whoops. Doing a little shuffle there. JR, it pulled right back to resistance inside of triggers. Not the best look because of these divergences, but the pattern is still true. And it didn't get to the wrong side of the triggers. And with that momentum, the area did break. And it did continue down. So that's your pattern. There's another one of those potential to breaks. Do you see it, guys? But it didn't. Right here, the smalls smashed through, but the large didn't. And JR, this is why you've got to learn the basic rules. Did you notice 3 divergences in the same price range? That's a termination condition. Guys, these 3 divergences told you that area is probably not going to break. And it didn't. Pretty cool, right? Small chart told you what you couldn't see on the large chart. So guys, learn these very basic concepts. And going into the weekend, man, you've got such a great opportunity. Do this drill on the weekend. You don't have to be in a trade to become brilliant, guys. All you got to do is snap pictures. And this is chart reading 101. And I can tell you right now, everybody that does this gets to where they want to be faster. So make the choice. Either you want to get there faster or you want to flounder and struggle trying to learn these concepts. It's up to you. The goal is that you look at your large chart. Identify momentum, identify clear path. That's it. That's your core. That's the foundation. Once you understand these things, guys, everything else kind of falls into place. 25 pictures each of strong triggers, and then 25 pictures of weak triggers. Know the difference between the two. Annotate the picture you take. So every time you take a picture of strong triggers, you should be typing onto that chart. Colors are the same. Separation between the two. Odds favorable momentum. Rule number 1 met. And what it does is it creates this correlation. It links your eyes and your brain. And your brain takes what your eyes see and it creates that verbiage. This is my advantage. Odds are favorable. That is strong. Or this is weakness. Anything could happen. Why the hell am I taking a trade? This is a clear path. There's nothing in the way to create a bounce. This is a termination condition. I don't know what's going to happen. Why on earth am I taking the trade? Guys, post these pictures in your spreadsheet. I've done a lot of work for you already. All of these pictures probably took me a total of 4 hours. Your mileage may vary, depend on your ability to type. But if you go look at 25 pictures annotated of strong triggers, you shouldn't make the mistake of trading with weakness. And if you really know what it means to have a clear path, if those words ring in your head, my triggers have to break through the area, guys, there's no reason for you to ever trade into a termination condition. So go through that this weekend. That's your homework. And then as you do it, here's pictures of what you should be taking pictures of. The first one is strong tops and bottoms. This isn't mandatory for the high probability trend trade, JR. It is mandatory for the 50-50 trade. So if you can't identify a strong top or bottom, how are you going to break outside of that first trade? It is a no triggers through termination that reverses the market. Here it's a termination condition. Price reaches the area, triggers remain below. It remains only a termination condition until the large roll from green to red. Now it's a strong top 10 bars later. Then it's a termination condition. Now it's a strong bottom 5 bars later when the market reverses, when those large triggers roll. Do you have momentum? Are the odds favorable? Or do you have weakness? Could anything happen? Know the difference. Use this as you take those pictures. Know whether it's a termination condition. Absolutely no trades. If it's that 50-50 look with the potential to break, manage assertively. Or if it is high probability, let's see if we can't get to the next area. Define your entries, because when you understand where the market is likely to continue, you know where the market shouldn't go. And then I'm giving you guys the second page. This is the trend trade checklist. Once again, this is the best of the best, guys. Is the market coming from a strong top or bottom? It's not mandatory. You can take a trade without a strong top or bottom, but you might have to manage it a little more aggressively. Do I have odds favorable on both charts? Guys, if both of your charts are screaming in the direction of the trend, it's difficult to stop that momentum. No terminations, areas inside of favorable large triggers. I also encourage you guys to write these on the chart. Every time you take a trade, go through and write these out. Know exactly what you're doing so the great things become repeatable. And then the KISS plan, guys. I love this. This is my baby. And since it's Friday, we're going to play story time. So I had a gentleman call me at the request of one of our client advisors. And he said, Mark, I can't find a damn trade. I know the software is good, but I can't seem to find anything but losers. And I asked him, I said, all right, Bob, Joe, Jill, Sally, Jen. I said, what are you looking for? And the reply was, well, I'm looking for that high probability trend trade you talk about, and I'm also looking for that 50-50 trade. I don't want to miss an HVA trade, and I'm trying to catch a momentum trade. I've got a trade that works off that gap theory. I've got one that's counter trend, and then I got one that's just kind of jumping in. And he told me like 7 different trades. And what he did is he confused the rules for all those trades, and he never took the right trade, and all he could find was losers. Guys, he was looking for too much. So I said, let's back it up. Let's calm it down. Let's build a KISS plan. Let's keep it simple. And that's what we did, guys, and that's where this came from. And it redirected his efforts to finding the best trade instead of every trade. Because trades billions, guys, every hour. All you have to make is 400 a day. So this plan is a stepping stone. This is A to your Z. This is the beginning. This is the foundation, guys. And it's designed to optimize your chances of success with the high probability trend trade as a new user. This is the best of the best. And then through simulation, study, class feedback, and continuous practice, guys, you're going to create your own plan. You're going to see more patterns. You're going to do things outside of this trade. But you're going to do it based on your ability to read the indicators. That's what this trade is doing for you. When it's time to go live, after you've practiced, you're feeling good, there's 2 things you have to be 100% sure of. What you have to know. Why will I enter a trade? Because my rules are met. That should be your only answer. Because your rules are nothing more than a description of a pattern that has been proven to win more than it loses. That's what the high probability trend trade is. And if you go back and study it, practice it, verify it, believe that it's true, you'll never hesitate taking this trade. You'll never talk yourself out of the perfect trade because you know 7 or 8 out of every 10 you're going to find success. And there's going to be a couple that get you. And you got to know why you'll exit. And exiting is getting out of that trade because your advantage is gone. So maybe 3 divergences print in the same price range. Maybe it goes to the other side of those triggers where the market shouldn't go. Understanding that keeps you from hoping stuff works when your indicators tell you that it won't. So define your entry because great entries create manageable trades and reduce risk. And guys, your great entry is mandatory to be able to manage it using this KISS plan. The KISS plan is designed to use 2 contracts at entry, and it is focused on putting your stops in the correct spot and getting you paid because the goal of trading is to get paid. And most new users, because when you think of day trading and futures trading, everybody says, hell yeah, $1 million. That's what's going to happen. But for some reason, new users try to make that $1 million in their first trade. Guys, consistency is key. So this is designed to get you paid, and it is 100% dependent on your ability to enter where the market is most likely to continue. So let's go through the very basic, if-then, pragmatic, emotionless, no room for opinion plan. If your entry is 2 ticks below the area inside of favorable large triggers, then your initial stop is 4 to 5 ticks beyond the trigger lines. This is where the market should not go. You will know your risk before you enter a trade. You'll have to decide whether or not you're willing to accept it. I can't tell you if it's too much or too little. Only you know that answer. But that's where it goes. And this is $150 per contract getting into this trade. Targets are predefined at $100 and $200. If I don't get stopped out, then I get a reversal bar in the direction of the trade. The same way a reversal bar said, hey, the fight is on, a reversal bar lets me know, hey, looks like the small crowd just lost or is in the process of losing. So if a reversal bar prints in the direction of your trade, you're going to redefine where the market should not go. Your new stop is 2 ticks above that reversal bar. You now have $30 risk in this trade. Doesn't guarantee a winner, but that loser doesn't hurt so bad at only $30. If they don't come get your stop, it means they went to your first target. Your first target is $100. That contract is removed. The first contract is off. The money goes to your account. Your palms stop sweating. Your heart rate slows down. And with one contract remaining, you're going to move your stop to break even. Guys, you are $100 in the good with nothing to lose. And this is where developing trust comes in, because people hate to give it back. They hate to give it back. I'm going to tell you, when you're on simulator, let this ride, guys. Just wait and see what happens. And if they don't get you break even, they go to your second target, that $200 target, which means you just made $300. $300 is pretty cool. And half of you in this room, so Cav, was it because of the speed of the market? You took the right trades, just couldn't manage them because it was too fast? That happens sometimes with NASDAQ. I don't like trading NASDAQ off the open. That's just me. I'm glad I'm teaching this class. Guys, that's $300. So show of hands. Let's be real honest right now with each other. Who doesn't feel like $300 is enough money? Mine's up. I don't feel like a $300 day is worth my time. Why the hell would I trade for $300, right? I'm going to show you something kind of cool. If you consistently make $300 a day, that's a $75,000 year. That doesn't suck, guys. But this is one of the misconceptions with futures trading, is that you have to make all the money in a day. If you make $300 a day, it's 75 grand a year. Add 100 of that. Make $200 per contract. That's a 6-figure income. And here's the part that nobody seems to remember, is the trading day goes from 9:30 a.m. or 8:30 a.m. Central until pretty much 3:30. So what is that? Gosh, it's math. 7 hours. 7 times 60. So guys, in 420 minutes of trading, that $300 trade was 4 of it. 1% of the trading day was enough for a $75,000 year. Does anyone believe that you're only going to get one trade a day? And even if you did, who cares if it's 300? So remember, it's not about making all the money every trade, guys. It's learning how to get paid. Daily profits reached consistently is what reaches long-term goals. As you grow, learn, and understand more, the potential for higher rewards, for bigger days, for more money, guys, it becomes evident. And here's one of the most kick-ass things ever. If you can figure out how to flawlessly make $100 a day, every day, there's no doubt in my mind. Is there anyone that doesn't believe they couldn't do that? We all believe we can make $100 a day. Who's doing it? Nobody, because they're trying to make 1,000 and they're giving it all back. Guys, make $100 a day. Use one of those trade copiers. Nexgen's building one. It's freaking amazing. That $100 a day translates to $1,000 a day if you spread it out over 10 accounts, which means suddenly you're making $250,000 a year based on $100 a day. Nexgen used to have a client that would trade like 100 lot or something on the S&P, and his goal was 1 point. 1 point was his goal, to have everything in his favor, to get in, get out, call it a day. And he was making $40,000 to $50,000 a day like that, because he had a pattern where he knew that was capable. Guys, it's not about making all the money. It's about making the best money. So here's what we're going to do. I'm not going to save those changes. We're going to do a little review real quick. So The one thing I tell people every morning is I'm going to give you everything that you need to be successful with the software. Everything. And I just done it. So I put my spreadsheet in there in the chat box. I'm doing it again. I'm putting a zip file. All you need. Inside of that zip file is Chart Reading 101. It's the High Probability Trend Trade Checklist. It's the KISS plan. It is the PowerPoint that I used to teach each and every morning. It is everything you need. Every rule, every way to identify it, how to study it, how to get feedback. And guys, this is what we do every day. This is also in there. This is called Trend Trade Simple. 5 days a week, live, we go over these 3 rules. We talk about the advantages. Everything that I've discussed in the last 2 hours has been consolidated into 2 pages to define your entry, guys. It doesn't have to be difficult. It can be easy. And for new users, and you know who you are if you're not posting pictures yet. And I want you to take a second to say, damn, he keeps saying post pictures, but I'm not doing it. Maybe you're scared, right? Maybe, and that's cool. I don't want to be wrong. Am I the only one that doesn't want to be wrong? I don't want to be wrong in front of a group of strangers. So change your name. JR become RJ. Lou Dog become Louise Sue, right? Gary be Jerry and Jen be, I don't know, Fabio. If you're afraid that the people are going to bump into you in the grocery store and ridicule you for taking a mistake trade, you're fooling yourself. Get over your pride, get over your ego. Start asking for those private sessions, guys. Pictures you can take. This is in that file as well. When you set your limit order, take a picture. Don't annotate it. You're busy. Go back to it later. Make sure your rules were met. During the trade, when you take profits, when you move stops, take a picture. You're going to use that to work on your management plan. After the trade, when profits are collected or losses are realized, take a picture, write your rules, point them out, police yourself. Make sure you have the advantages that you need. And then number 4 is when you don't have a trade. When you say to yourself, my rules are not met, I don't have the advantages that I feel should put me in a trade, take that picture and remind yourself that I don't trade without momentum, that I don't trade into termination conditions, that termination conditions can stop the market. And that's why Mark says 90% of the day is waiting. Jen, thank you for that picture. I can't, JR. If all you post in the room is that, what am I going to do with that? Right? Or JR, even this, check it out. You'll like this. Maybe you won't. I don't know. If you take a picture and you drop it in the room and you say, damn it. And this is what you give me in the room. And guys, believe me, this has happened. How do I know why you entered here? But if you take the time to point and say odds favorable momentum, well then it lets me know that you understand momentum, that you know that this was a market. And if you said this was weak, well then it lets me know that we need a lesson on momentum. And if you say this was a clear path, it lets me know that you don't understand that this was a 50-50, that it's only potential. And I'll give you the lesson. And if you took this trade anyway, it means that you don't understand that divergence kills a 50-50 more often than it doesn't, and you get a lesson. And JR, that's how it works for like the first 30 days. There's more great information and pictures than there is in struggling with trades. And if you give me this information every time, if you know what you're up against, if you know what the advantages are, and you let me know what your chart read is, I will give you the best freaking feedback that I could ever give you. And I'm telling you right now, that's what the second hour is. 100%. Some of you might have taken a loser here. It was momentum and the potential to break. But it was 1, 2, 3 areas you were hoping would break. And if you go back to the KISS plan, there's your entry rules for the 50-50. And it says the best way to do it is one area not broken. And it absolutely insists on a strong top or bottom. And it says no divergence, not once, not twice, but 3 times. But until you understand those very basic concepts from the high probability trend trade, you're likely to struggle with the other trades. So, that being said, first hour's done, guys. You now have everything you need to be successful with the software. I'm going to go stretch my legs for 5 minutes. I say 5, I always come back in 2. When I come back, the feedback is going to begin. So let me share one more thing. I stink at leaving. The key to everything, and I want you to believe this wholeheartedly, the key to everything is having a foundation, understanding those basics, and just get a little better every day. So for you new users, I'm going to blanket you with very conservative rules. Terminations, no momentum, areas outside of triggers, they're all horrible. They're all detrimental. Financial suicide, don't do it. And those blanket rules are there because it increases the likelihood of success, and that's what gives birth to confidence, guys. And they're not always bad, but if you're brand new, you're not going to know when to use an exception. So just like anything, the more time you spend, the more pictures you take, the more feedback you receive, guys, you're going to start to see things. You're going to see patterns. It's going to open doors for you. Stop trying to be at the finish line. So learn the process that yields results. Learn one trade that has been proven to win more than it loses. Give yourself the ability to make money while you grow with the software. And that's where the KISS plan comes in. Chef is people. People have gotten funded in those prop firms in their first 30 days with Nexgen following the KISS plan. I'm going to get you a t-shirt, Chef. Because it's easy. Because it's the highest chance of success, guys, and you can find an extraordinary level of success looking for the best instead of all. The further you go from easy, the longer it takes to get good at this, guys. So question everything, interrupt, post pictures, ask questions, monopolize the time. And what you're going to find is that it's impossible to monopolize the time because I will always make more time to make sure that your questions are answered. And then my favorite phrase, give yourself some grace. You're brand new. You're learning something new. You are learning a new skill set that could change your life forever. Be willing to take a little time and put a little effort in. Give it everything you have to be consistent and to have advantages, and you will be absolutely floored at how it can change your life. So I'll be back in 5 minutes, guys. Go stretch your legs, pet your dogs, play with the cat. I'll be back, and then we'll get into all the feedback. And then if you have questions, just type them in the room. I'll get them. See you in a minute, guys. All right, y'all, here we go. Second half of the day. So I'm going to go through all of these pictures in order. Just so you know, I've got to scroll to the top and then I've got to scroll back down to give you feedback. If for some reason I accidentally miss a picture, let me know. We'll backtrack, we'll get to it, we'll make sure that you're taken care of. I don't want to miss anybody's at all. So Morgan asked, and Morgan, one of the things that would have helped me on this one, and this is why I wanted to talk about it. Are you in here? Morgan says, is this a strong bottom? The fib stopped printing. Man, so Morgan, was this the middle of the night? I noticed that you posted it at like almost 1 a.m. my time. So how long did it take that bar to print? And man, we're 2 ticks off of it, right? 3 ticks off of it. I'm assuming, I can't tell, maybe it's the NASDAQ. Okay, so we missed that area by a tick. 2 ticks. Triggers don't break. And it looks like it's in the process of reversing. Morgan, I would call that a strong top. The fact that the second line of those small triggers didn't seem to break this one, I'm calling this a strong bottom. And guys, here's a cool little lesson, and this is why I wanted to talk about it. Your Fibonacci areas, for you guys that haven't seen this yet, I love this picture. This is how those fibs are created. When you open your software, your software goes through every pivot, every up and every down. And just for a point of reference, if you look at the NASDAQ during one day, there's probably 1,000 pivots, 1,000 up and downs, easily. Well, then your software goes back 10 days, and then it creates synthetic higher and lower time frames. And it does this, and there are literally thousands upon thousands of Fibonacci projections and alternates and all the things that make fibs. And then Nexgen software comes in and it sorts them and weighs them and which is most important. And from all of those calculations, it's still calculating, so I'm not going to mess with it. From all of those calculations, you get fibs, you get support, you get resistance. So Morgan, I'm 2 ticks off of Fibonacci support, no triggers break through. I'm going to call it a strong bottom. Does that make sense? Understanding that these are areas. Yeah. And I put in the room, you're going to have to make a judgment call, right? So if you're trying to catch a 50-50 the other direction, and everything is perfect, Morgan, and you're like, I'm just not sure. Are you willing to take the trade? I probably would. I would make the judgment call. Everything else is perfect. It missed it by a tick. I'm going to call that a strong bottom. I'm going to take this trade. Make sense? That's a great question, though. And an awesome segue to open the door for me to talk about how your fibs are created. You assume weak if you don't know, and you know what? That's probably erring on the side of safety. Nothing wrong with that. And Morgan, I rebuilt everything this morning. Every chart got rebuilt this morning. All of my data got wiped out. 100% fresh, brand new workspaces. That was for you. All right, guys. It's the Wayne Show. I love it because Wayne gives us multiples. And Wayne, I'm just going to do all 10 of them so that we can go in order. And you're welcome, Morgan. Keep those great questions coming. Ever had heartburn before a chili dog? Back of the bar clears trouble. And guys, let me talk about why Wayne says back of the bar clears trouble. Because if decisions are made at key areas, doesn't it make sense to get price away from those decision-making points? This is a trade called the chili dog. And the chili dog is not a Nexgen trade. It is a trade that is 100% dependent on momentum. Momentum and clear path. Thanks, Ron C. He created it. So odds favorable momentum. Second chart has odds favorable momentum. Third chart has odds favorable momentum. Guys, if you're taking a momentum trade, every chart you have better have momentum, or it's not a momentum trade. And Wayne says, let me get past trouble everywhere. I'm going to jump in, but because it's only momentum, I'm going to get paid quick. I'm going to get paid quick. I'm going to get out before that momentum has a chance to subside. And Wayne, absolutely perfect execution on the chili dog there. Until the back of the price bars get beyond these lines, no trades. Rule number 2. I like this. Guys, this is one of those no trade pictures. This is Wayne looking at a large chart saying rule number 2 has defined a range, and until I break out of that range, I choose not to trade. And Wayne, brilliant. Absolutely brilliant. There's 2 pictures so far this morning of people saying my rules aren't met, I won't take a trade. Would have been a failed chili dog. Yep. But did it fit the rules, Wayne? Then it's okay, right? Because it wins more than it loses. And guys, may pull back to the 1-to-1s, may pull back to the mid-band, or continue up. So in absence of clear indicators, you're going to do nothing. So the reality is you've got a strong bottom. You've got odds favorable. You have the potential to break. This failed chili dog could turn into a trend trade. That's it. This could turn into a 50-50 trade. So if that divergence is true, Wayne, can we take this a step further? Take care, Cav. You may like this. See how the divergence potential is there? So if you take the momentum trade off the 1-to-1s, that's cool if it goes up. If divergence prints, then you'll have divergence on a 50-50. So if you're waiting for the trend trade very often, waiting to see if that divergence is true on a 50-50, gives you an advantage. So instead of getting in at the area right here arbitrarily, you might wait for a couple bars to see if divergence is true or not. It gives you that little heads up. So when you know your rules, if divergence is a killer, yeah, it gives you a second. Let me wait for divergence, because divergence could screw up all this forward progress. And this is the annotation that I really liked, guys. So 4 large chart divergences. Buyers said no. I love that annotation because it means that Wayne understands what divergence is. Divergence from a low means that the sellers tried to go and the buyers pushed them back up and stole their momentum. And man, they did it 4 times. 4 times the buyers said, no, sellers. No, dagnabbit. I don't want that to happen. I love that annotation. And then Wayne, there's the one. When the chili dog failed, it turned into the perfect 50-50 from a strong bottom, no divergence, strong triggers, area inside of triggers, and easy freaking money. Pretty cool, right? So maybe, and guys, this just rattled through my brain. Maybe if that divergence potential is there, you hold off on the chili dog and wait and see what happens. I don't know. I don't know what the answer is on that. Or you wait for a little fight, then up. But your patience was awesome, Wayne, and it resulted in an absolutely beautiful, easy money trade. And I love that. Buyers said no. I wouldn't say you missed it. You were going to try and take a heartburn trade here? That's why I struggle with that. I know it's your trade, man, but... Oh, right here. The pullback. So, man, Wayne, if you're thinking chili dog, but you're at the outer bounds, I guess that's a no, huh? Because that's your heartburn trade. That's pretty cool. No chili dogs into an outer band. I love it. Isn't it funny how everything comes together? Guys, your chart reads, you start to see things and they all intertwine and create advantages. I love that. I didn't even really think about that, Wayne. I've never put the two together until just now. Very smart. I can be taught 50-50 with divergence. No long trades. Wayne, can we talk about even more than just 50-50 with divergence here? Oops, I didn't get the whole picture, but it works out. So check it out. I don't have momentum. The smalls are inside of the large. I don't have a clear path. It didn't break the one-to-ones. I don't have an area inside of triggers. Holy crap. I don't have anything that I look for in a trade here. So Wayne, it's not a 50-50. In order for it to be a 50-50, you have to have momentum. That is weak triggers at a potential termination with no areas inside of triggers. All your areas are on the wrong side. This was a great miss. That was a, well, I can't see your other charts when I'm looking at that one, silly. And using the gap theory, when price reaches mid bands, one-to-ones, resistance, and the large triggers are a full bar away, it's likely to close that gap. Wayne says, I'll try to close that gap. Gets in on the good side of triggers, makes quick money down to the triggers. Entered half bar below the term. I love it. Let's get below those areas. Bounce off large chart mid band. ATM was 100 per contract. Just above the synthetic triggers where price is likely to return. This is taking a chart read and going counter trend, fighting the up. Because the pattern says, especially from a bad bottom, it's likely to close the gap to those triggers. And you did it beautifully, Wayne. Once again, putting on a clinic. And then there's the gap again. That's the one you just took. Gap was greater than a bar. Nicely done. Double annotations. And then when everything breaks below, those are two different gap theories? My bad. I thought that was the exact same trade. It is different. Nicely done. You know how you know you're becoming a confident, successful trader? Your trades look the same and Mark can't tell the difference between them at first glance. It means you're following some rules, Wayne. Sorry about that. Same trade, same look, same entry, same exit, same result. Money, money. And then when everything rolls and you've got a clear path and the momentum is on all three charts, you chili dog it and make more money. And when everything is going up, let's see, failed chili dog. Oh, that's the one you did, right? It hits the outer band. And that's your heartburn trade. And now that's a no entry condition for that chili dog. I love it. So this was lesson learned, and eventually it'll become avoidable losses. Nicely done again, Wayne. And then the last one. Jumped into, heartburn into, jump the fudge in with weak bottom, odds favorable, clear path. Yep. Entered at outer band on the way down. Literally have 1 second or less to place the sell market orders usually. Then while the white bar at the top printed, you knew it was a 90% winner. Set the target above the small chart mid band. Beautiful. And then when everything rolls off of the termination, you jump in and you're able, oh, didn't quite work. It pulled against you. You got out with the reversal bar. Nothing wrong with that. So the one thing is on the chili dog, you don't have odds favorable momentum on the small chart. You don't have odds favorable momentum on your range chart. And your small triggers had probably already started turning against you on the large chart. Does that make sense? That's the thing about that chili dog trade, guys, is we get real excited about just jumping into the market. You've got to be super, super diligent on making sure that you have the momentum. Because the whole basis of the trade is momentum. It's a momentum-based trade. Wayne, absolutely awesome trading this morning. Great job. Miss Jen. Let's get a little feedback for Miss Jen. Price reaches resistance. Triggers don't break. Divergence from the high, letting know. Seller said no. I like that. Wayne, I'm going to start using your language on that. Becomes a 50-50 trade. Smalls below, larger above. Jen knows that the small triggers are railing up. Waits for a close on the other side. Takes first profits. Gets out with a divergence. And Jen, I took the exact same trade damn near to the ticks. Nicely done. And I waited for that stupid trade for so long. Great trade, Jen. It's like we were sitting in the same room. I mean, we did that exactly the same. Andyman. Andyman says, I can do it too, guys. When I've got momentum and the potential to break, man, I'm going to sell an area inside of triggers, and I'm going to get paid on the way down. Andy, great trade. Strong top, odds favorable, clear path. Everything says down, and eventually you'll hold for that trouble spot. You'll believe that momentum and path can carry you to the next area, and you'll wait for your small chart to show you change before you exit. Great job, Andy. Nice trade. All right, who's next? And ladies and gentlemen, I want to remind you that you are always welcome to ask questions about someone else's chart. You can ask whys. I don't mind going through them. Just remember that somebody else's chart is based on their chart reading. Somebody else's chart is based on their rules. So it may not be your trade yet. All right. Odds favorable momentum without a doubt. Doesn't look like price reached the area yet, so you take the momentum trade. Momentum on both charts, break, snap, continue. Isn't that great on the NASDAQ, Steve? You can make $200 before that up bar even prints. That's awesome. One of the cool things about NASDAQ. Nicely done. Great looking momentum trade. Ooh, we got all the trades here. Odds favorable. There's that Nexgen momentum trade. Odds favorable. There's that chili dog jump in. Perfect. Odds favorable. Mid-band's not a turn because the triggers aren't a full bar away. There's that Nexgen momentum trade. Perfect again. Steve Diego. Freaking amazing, guys. Awesome. Awesome trading. Beautiful. All right, guys. Stare at the S&P for a second. My dog needs to go out. I got to go let my dog out real quick. There's the small chart. Momentum, path. Looks like we might have taken a loser there. Happens sometimes. I'll be back in 2 seconds. All right, I'm back. The dog says sorry. Let's see who's next. All right, Wayne. I told you you'd post again. Chili dog, then heartburn. So, odds favorable momentum, back of the bar clears, momentum on all three charts. Wayne, the only thing that you have modified on the chili dog is you're trading directly into the one-to-one, and that one-to-one can create a bounce. One of the things about the chili dog is that back of the bar clears on every chart. That's the highest chance of success. Just throwing that out there. You do you, for sure. And then you get your outer band and close below and heartburn it, and it doesn't hurt that you have weak triggers right at a termination condition too. I have a feeling that that even adds to it a little bit, but that pattern, solid, dude. Solid, solid. And that just may be your modified version of the chili dog, willing to trade into it on the small chart when the large chart's strong. That's up to you. You missed it on that one, but have pulled out of other trades. Right on. Joel, odds favorable, clear path, separation small to large, open like scissors. Absolutely. Perfect chart read. Perfect chart read. So those 1-to-1s started printing at 8:47 a.m. You traded into them at 8:48, about a minute later. So you had about a minute heads up on those. But you were probably focused over here waiting for the bar to clear. That was one of the things that I noticed I did, Wayne, in the beginning, is I would be so hyper-focused on the bar clearing that I would just be hovering over a buy button and forget to look at that one. And then with it also being 1-to-1s directly into the outer band. And it's easy when the charts aren't moving, guys. It is so easy when the charts aren't moving to look like an absolute rock star. Because there's no motion. There's no fear. And then, right on. But the mathematical entry point should be rendered void if the rules aren't met, right? So it's not an entry point if the rules aren't met. You put your buy market where that up bar would clear the large chart. It's just a language thing. So weak triggers, anything can happen. Yeah, I've done that. That's why I noticed it. I'm telling you guys, there's nothing you can do that I haven't done. There's nothing you can mess up that I haven't messed up. So I look at it, I'm like, oh my gosh, that's one of my old charts. Let me help you. Let me tell you how I fixed it. Or let me tell you how I changed it. This is pretty cool, guys. Anything can happen, triggers. Everything's down, but anything can happen. We're 2 ticks off of support. Divergence prints, weak triggers, and Ron, this is like your heartburn train without the range chart. Ron says when these roll up, when divergence prints, when these are weak, I'm probably going to get a retracement. And he does that quick little 11 ticks thing there. Little base hit, guys. Base hits pay bills. All right, Miss Jen. Mid-band was a term, odds favorable, potential to break. Little late on the entry, but you carry it up. Nicely done. Great trade, Jen. Just a 50-50 from the right spot. Even a little late with all those advantages. Easy money. Love it. And then Chef. I like this. Chef, my favorite thing about your posts are Chef's mental mind. Just one time, I want you to post before that. Hello, children. Chef's mental mind. Give me the Liza K's on it. I think South Park every time I see your charts or I see your name. All right, so odds favorable momentum. Large triggers were not completely through. Why does Chef put large triggers not completely through? It lets him know that he might need to manage. That's it. When you know what you're up against, you know whether or not you need to manage or let it flow. And he's like, man, if something gets crazy, I might have to get out of here. Targets filled. Good bottom. I like it. So on this trade, I entered below the area. This is a bad habit I have. But you're still in the range, right? So you're still in the window of opportunity, Chef, but you're absolutely right. You may run the risk of missing that trade, being below the highest point of support. I guess you're willing to take it. That's okay. Focus more on the entry. This was 19 ticks in less than a minute on 4 contracts. The day is done, but practice, practice, practice. I will continue to hear those words, target filled. I love those words. So, Chef, why did you choose to ignore 3 divergences? That would be my only question. What made you believe in the moment that 3 divergences? There you go. But it worked out. So, Chef, a good bottom, crazy strong triggers, almost a clear path, everything says up. It's more likely to go up than down. If you were going to take a shot at fighting 3 divergences, that's about the best look you could ever have. Nicely done. And then you guys want a little pattern lesson? And we haven't talked about this one in a while. Let me take the picture. Does everybody know what a pivot stop out is? A PSO. When you get one of those divergence lines and they take it out by a tick or two and then head down, that's a pivot stop out. So there's a pattern here. This second divergence typically takes out that lower divergence, Chef. Which means your entry makes a lot of sense. This is one of the things, when I see this above me, I tend to wait for it to take out this pivot, and then I'll look for my entry. And it happens a lot. And let's go see if we can find an example of it happening. We'll just open up a small chart here. So there it is. You see it? And it pushes just below the previous pink, and that's where it tries to head back up. And whoops. I think this was yours. Pivot stop out takes out the previous. That was actually your trade. Even on this one, pivot stop out. Look where the next big bounce comes from. That previous low. That one didn't quite get there. But eventually it does take out the previous low. Kind of a cool little thing. When everything's right on the large chart, if you're trying to figure out your entry spot, recognizing that pattern of the pivot stop out, I'm looking for it one more time. And remember, the large chart rules have to be met. But there it is again, Chef. Do you see it? It looks like everything rolled. You probably had strong triggers. Pivot stop out. It takes out that previous pivot by a tick, and that's when it heads down. So that might keep me from just getting in at a mid band. I'm going to say, well, I at least need it to get up to that divergence high. That's just a pattern, guys. It's not a rule. It's just a pattern. There it is again. Pivot stop out. Right above it. And sure enough, that's where it starts down. These are the things that you begin to notice when you don't have to think so hard about finding the trade, right? Even this one divergence takes out the previous pivot. This one divergence took out the previous pivot. Now we have the higher divergence. Let's see if it takes out the previous pivot. Isn't that neat? Creating could-be scenarios based on patterns that repeat themselves all the time. All right, so there's your S&P right into a termination condition. Whoops. There is my untitled workspace. So let me close that so we can get to the actual workspaces. There we go. Crude oil. Look at that. 3 divergences in the same price range. Buyers said no. That thing's cranking to the upside. Guys, what do you want to talk about? We got an hour to get smart. We got an hour to talk about things. We've got an hour to answer questions. Oh, was there? Oh, you did the double up on me there. Sorry, I didn't see that. That's my bad. Termination, full reversal, Odds favorable. MNQ, Gary. So no divergence. It starts to pull back but doesn't make it. So you catch it on the way up. And you're caught in between momentum trade and trend trade here, Chef. So you say, "Gah, if I get a confirmation bar, I'll take it because of this look in that bottom." And just easy money, man. Easy money. 60 ticks. Beautiful trade. All right. Chef's mental mind. I'm working on trusting the process more and holding instead of jumping out when I reach an arbitrary number amount. Work in progress, but I like the results. So let's talk about this. Chef, I want you to remember this magic phrase. Here, let's do that. What changed? This was the phrase that helped me manage trades better. So there's your entry. Nothing has changed, right? The triggers are still up. Support still held. Nothing has changed. Nothing has changed. Nothing has changed. Nothing has changed. This is the first look at any change, is that divergence right there. That's the first time anything gives any indication that things are changing. So a lot of times I'll say to myself, all right, I will do, and you're trading 4 contracts, or you're trading 3, you're trading 4, so that's perfect. You take 3 off at a number, and then why did you exit here? Because where you exited here, just before the 1-to-1s, okay. So when I'm trend trading, I'm looking for 0550. Does that make sense? And if nothing changes on my chart between my entry and 0550, I'm going to 0550. That's the expectation of a trend trade. 1 divergence doesn't faze me. 2 divergences don't faze me. 3 divergences, and that happened to be right at your target. So you hit your target right there, and you're out right at it. I love it. That would be a reason for an exit. Your advantage is gone. And I use that when I talk about it. So every now and then I'll lock in money, Chef, and I'm not afraid to lock in money. If I'm up $300, shit, I'm not giving back more than 100 of it. They can come get me. I don't care. I'll take my 200 plus my first profits. I'll walk away and I'll wait for the next trade because there's always a next trade. But when you're doing those runners, it's nice. If you use that phrase, what changed, a lot of times it keeps you in the trade. And even if you're not looking to exit, and let me see if I can find a better example. Oh my gosh, these are all perfect, so it's hard to. So if I were in this trade, Chef, and let's say I'm in at this mid-band, and right here I'm getting nervous, and I have to ask myself, what changed? Well, the small triggers are now in the direction of the trend too. That's a positive. I'm less likely to jump out. And I'm thinking, ooh, maybe I should jump out at these triggers. And I say to myself, what changed? Nothing. These small triggers just got stronger. And then I'm thinking, well, maybe at this pivot low, I should get out. And I say to myself, what changed? And if I'm looking at it, I'm going, oh my gosh, this just keeps getting better and better. And I think that phrase, that question, what changed, it helps a lot with management. And you've got to be able to recognize change quickly or recognize that change hasn't happened quickly. I hope that makes sense. That helped me a lot with management. Really looking at where I'm at in the trade. And you know, my brother used to do that. He goes, Yeah, everything's going up. He goes, as we pull back, there's no way I'm going to exit. Look at my small triggers. They're still up and outside. I'm not going to exit. I'm not going to get out because of a down bar. I'm going to let it bounce off support because it's likely to. And he'll use that same idea. What's changed? And it helped me a lot. It takes a while to get good at it. It takes even longer to trust it because we lie to ourselves all day long. Well, I had strong triggers in a clear path. No, you didn't, you big silly. You had weakening triggers and the potential to break. Here you have strong triggers and the potential to break. And look at that, it pulls right back to support inside. Second divergence for me would have been an exit. Might have re-entered on a confirmation bar. But that's kind of cool looking. We'll open up the NASDAQ. Gary, you bring up an interesting conversation that John Novak and I had yesterday based on micros. And it's one of the things that we're talking about, and the idea wasn't as well received as I wished it would have been. But John and I were talking, what if, and guys, give me some feedback here. What if on the proprietary firm, what if on the funding company, there was a dip your toe opportunity? There was a can only trade micros, and it had a much smaller price tag so that you could get in, so you could trade micros, so you could test your plan, so you could feel good about it. So, you hit your goal or whatever. And then maybe the cost of that rolls into a full-size account. That was we're sort of going through ideas. I'd love feedback on that one because it was a mixed reaction between the Nexgen employees. I loved it because it was my idea and I'm brilliant. Some people say, well, they can trade micros on the normal one anyway. That's what I think. Because, well, you'll still make silly mistakes, Chef. But what happens is you don't have the added pressure of seeing $300 risk. You see 30, and it's easier for the brain to hold. It's easier for the brain to do it. There's still risk, but it won't kill you as quick. And the flip side of that, Andy, is you won't make money as fast, right? You're not going to get rich on micros, guys. Micros is where you're going to test your plan. Micros is where you're going to make sure you can follow your plan if you have to be in one of those prop firms. Oh yeah, for sure. For sure. But you'll experience the process. So just something that we were talking about. Look how fast the NASDAQ is. That's crazy. And that's it right there, Chef. So maybe an opportunity to not over leverage. So, it's got to be beneficial for both sides. I'm not going to copy somebody's account on micros and trade micros with it. But I think mentally there's a big calm, right? Wish your bank account knew it. Andy, you're turning into a chart reader. And a rule follower. Do you know the number one reason that I've found in my own experience? Do you know what the number one reason for not finding success with this software is? Can anyone guess? What I see every day producing losers? Trading without advantages. That's it. Well, overtrading comes from not following rules, Chef. Because if you're following the rules, you won't overtrade. You'll be taking the perfect number of trades if you learn to follow rules. Not following rules. That's it. And it sounds silly, right? Well, but my rules don't happen enough. but my rules don't have enough. I don't get enough trades. Do you know why people say they don't get enough trades? Is because they're trying to recover from the 10 wrong trades that they took. Imagine if you never took a wrong trade. So if you looked at your P&L today, this morning, I'm up $400 coming into class. That's it. It was a slow morning. There was a lot of waiting. I should be up $700, but I made a mistake. That's a huge difference, guys. I made one mistake that cost me $300, and that's the difference between being up 6 figures a year and being up $176,000 a year. Big difference, right? From one mistake, one eliminated mistake, changes the whole dynamic of my day. And I want you guys to think about that. You're going to make mistakes, right? But the more you weed them out, the less you make them, the more likely you are to not have to fight to get that P&L up. You'll still take losers. But if you're only taking the right losers, if you're exiting when the advantage is gone, it's pretty crazy how that P&L grows. We've got about an hour. Am I going to do my Friday gum flapping thing where I say, hey, check it out. Here's 7 habits of highly successful traders. Crack a beer, curl up on the couch. It's a great read. Emotion-free trading. Pour a glass of wine. Get you a non-alcoholic beer. Curl up on the couch. It's a great read. It gets you thinking about the psychology. Go watch Mark Douglas videos this weekend, guys. Mark Douglas is no longer with us, unfortunately, but he and John Novak worked together a lot in the 90s. Okay. Just saw on CNN that Skype is shutting down. I don't know. I guess we'll find another way to talk. We don't use Skype a lot. We use it between the people that work at Nexgen. I don't really talk to clients a whole lot on Skype. There's too many scammers on Skype, and I hate seeing people giving money to scammers. So maybe that's why they're doing it. Maybe it's just overwhelmed with scammers. I'm going to put this in here. This is some Mark Douglas stuff. He's got a lot of great videos on YouTube, but he and John talked a lot. And a lot of what we talk about, they're not, Chef. They're not mine either. What's funny is when your own brother sends you a message asking for crypto saying he'll trade for you. I'm like, wait a minute. This might not be truthful. These are some ideas that Mark Douglas talks about, and we just kind of paraphrase. Are you in the right frame of mind to trade? Do you have COVID? Are you hungover? Did your girlfriend just leave you? Did your dog just bite you? Are you anxious about bills, right? Increase your awareness. Are you thinking about following rules, or are you thinking about making money? You got to believe that you really deserve a high level of profit in order to keep it. Yeah, Fake John approached me. Isn't that awesome? Morgan, don't block him. Trading without fear, hesitation, or internal conflict, guys. It's a function of believing you don't have to know what happens next on a trade-by-trade bias to win or make consistent money. Trading in the Zone is an amazing book. Guys, when you stop expecting to win every trade, you start winning most of your trades. When you don't care about the result, but rather the execution, that's what creates successful day traders. I'm going to follow my rules. My brother and I this morning were watching the NASDAQ together. We are trading the exact same set of rules right now. And I would say for every time our brains told us this should happen, our rules said don't take the trade. And I can tell you that it kept me out of at least 7 or 8 losers this morning. And we're just like, trade rules work, don't they? And they do. When you believe you know what is going to happen, you set yourself up for failure when you take a loss. I had a buddy text me yesterday. He goes, I was waiting for the perfect trade because I needed to win. And I was like, dude, you're not in control of that. Every time it's the perfect trade, you should take it. If it's not, why the hell are you taking it? He's like, God, I hate you, Mark. And I was like, I know, right? Pain in the ass. And it's not one trade. Don't get so emotionally attached to one trade, guys. Losers happen. Let it be 20, 25 trades. If I take the right trade 20 times, I should be in the black. I should not be in the red. The only thing the market is up and down ticks. Emotional pain comes from what you believe. You create your own pain. You ever watched your P&L in a trend trade fluctuate in a $100 range and it just freaks you out and you close for a small loss and then it goes? We've all done it. So that's pretty good. Go watch some videos. 2 divergences on a potential to break with weak triggers. It could go up from here. It's not my trade. It's just not my rules. It might fit one of y'all's rules. It doesn't fit mine. Doesn't mean it's not a good trade. It means I don't like the advantages. Probably would have lost that one. But it would have been okay because I would have made money on that one. And now we're just dancing. 3 divergences in the same price range. Odds favorable momentum. Looking to see if it gives me a reversal bar to give me a pullback to an area inside of triggers. That's how fast the NASDAQ moves. Potential to break. There's my area, but it's the NASDAQ. I've got to watch my small triggers versus reversal marker. Oh, I don't have an account set up. Whoops. But that was it. That was go at the area. And you already got paid at trouble. That's awesome. That's how fast the NASDAQ is. If you don't know your rules, it's gonna run you over. Cam's in the room. What's up, Cam? Cam's my hero. Just wanted you guys to know that. I want to say that out loud publicly. What are you going to talk about, ladies and gentlemen? We still have time. If you guys don't post a chart or ask a question, I'm going to have to go scrub toilets. I got company coming. Don't you do that to me. Wayne says he's got 5 minutes. He's doing a chart now. So I know I have something. I have something to look forward to. Tell you what, I'm going to take a few minutes. Post them if you got them, guys. I'll see you in a second. Nothing, huh? Weakened triggers, not a clear path, 2 divergences. I guess some of you said, I don't like it. Not enough advantages for me to risk my money. That's fair.